Hello and welcome to ChooseFI. Today on the show, you asked and we answered. So the biggest thing when I took over the show last year that you responded, you were interested in for an episode was drawdown strategies. We are talking about building up our assets over a financial life, over our investing careers. But what does it actually look like to draw down? So I actually asked two of the preeminent thinkers in the FI community. We have Karsten from Early Retirement Now and Fritz from the Retirement Manifesto, who are both multi-time guests here on the podcast. I asked them to come on and talk about this because, interestingly, they both have different strategies. And even more interestingly, they both early retired in June of 2018. So not only have they been living this drawdown strategy for 4+ years now, but they've also gone through a very interesting time, needless to say, with March 2020 and everything subsequent to that. So I think that in and of itself is going to be interesting. And then in the last month or so, they've had a public duel, as they like to call it, very jokingly, they're good friends, over their strategies. And I think Karsten called Fritz's strategy a gimmick or a cheap gimmick. So that adds a little fuel to the fire here. So I'm very, very fascinated to hear them talk through both their drawdown strategies in general and actually how they are doing this on the ground. So with that, welcome to ChooseFI. Gentlemen, welcome to ChooseFI. I really appreciate you both coming back. Karsten, why don't we start with you? So I think the best way to go through this episode, instead of starting off with our public duel here, is for each of you to describe roughly how your strategy works. And then we'll kind of compare and contrast and go from there. So obviously you've written 50 some odd parts of a safe withdrawal strategy. There's no way I could ask you to summarize in 1 or 2 minutes, but just give us a sense of how you conceptualize a drawdown strategy.
Yeah, so everybody's experience is different, right? So I had this little bit of a special situation where I didn't transition very abruptly into the drawdown strategy. For example, for the first 3 years of my retirement, I still had some compensation from my old job. So it's a deferred compensation that I still kept after I left my job. So I still had some cash flow just coming from that. I'm very lucky with a lot of people talk about asset allocation. There's also the asset location discussion, right? Where are your retirement assets actually located? Are they in retirement accounts or in taxable accounts? I'm actually quite lucky that I have a huge sum in a taxable account. So I don't have to worry about any of the taxation issues and potential early withdrawal penalties or anything like that. And then in that one relatively large taxable account, together with some of that deferred compensation, I actually had enough cash flow from dividend yield, interest income, make a little bit from my blog. And then I also do something that is probably not that widespread in the FI community. I do some option trading strategy, experts only. So I do that. That actually generated enough cash flow for me that I didn't even have to liquidate any of my assets. I still have all of my equity tax lots. I haven't liquidated any of that. And of course, the average retiree, right? You retire, you go from income to zero income, and you have to withdraw money. That wouldn't quite work that way, right? So you would probably have to start liquidating potentially assets because potentially your dividend yield might not be high enough to live just purely off of the dividend. So the average retiree obviously would have to liquidate some of their equity holdings, but I didn't have to do that yet. So lucky me.
Nice. Lucky you indeed. I like, as you described there, asset allocation and asset location, right? That location is an interesting thing that I think we often overlook. So you're saying you had a significant taxable brokerage account, right? So for people out there who might not be familiar with that really is just our normal savings. I think we get bogged down in that detail of what's taxable savings. So Karsten, just talk through that real quick.
Right. So it basically means it's not a retirement account. It's your regular brokerage account that before there were retirement accounts, that's all that people had. But yeah, you hold your equities there. The nice thing, even though it's called taxable, you don't have to tax any of your capital gains until you realize them, right? You preaching to the choir here, you're the accountant. But dividends would be considered taxable income. Interest income would be considered taxable incomes. The option trading profits, they're obviously capital gains. So they will be taxed right then and there when you realize them.
Gotcha. No, that makes perfect sense. Now, do you envision a scenario where, I guess I'm trying to understand, you haven't really had to sell any of your assets. Is there a time period or what might change where you would have to do that theoretically?
Right. So if cash flow needs change, if some of the income that I generate is drying up, yeah, absolutely, then I would have to sell some. And then obviously at some point you will have to tap into your retirement accounts, right? So whether it's through required minimum distributions, we also do a little bit of Roth conversions right now to take that little bit of that edge off further down into retirement. I don't want to make this too much about taxation and tax optimization because that's not what our discussion was about back in January. But yeah, I mean, at some point you will have to liquidate your retirement accounts. So that time will come. It hasn't come for me yet.
Gotcha. And yeah, like you said, there are required minimum distributions. So yes, there will come a time where literally by definition, you have to liquidate portions of that. So that makes sense. So, okay, great overview. We will certainly dive much more in depth. And I want to talk specifically about your strategic asset allocation and such, but let's throw it over to Fritz. So Fritz, first off, welcome back to the show. It's good to have you back.
Yeah, thanks. Great to be back. I appreciate it. And I think this discussion with Karsten is going to be very interesting. Let's go to your discussion about what retirement was like. For me, it was very much different than Karsten. Mine was, I would say, a more traditional approach, meaning I did have to start tapping investments and things like that. So I think the important place to start for me is probably 2 years before my retirement date. And I was very intentionally thinking about how do I transition into this withdrawal phase with the minimal amount of pain. I don't want to be a budgeter and have to track every penny we spend. I want to make sure I'm staying within my safe withdrawal rate, but I want to make it easy. So I came up with a system, I didn't invent it, it's out there, but basically I recreated a paycheck. And I set it up where every month there's an automatic transfer coming over from a standalone Capital One money market fund that I set up. And I automatically transfer it in just like I did my paycheck. And if there's money in my checking account, I know I can spend it. So I tried to keep it as simple as I could. And what's kind of behind the scene on this is very commonly known as the bucket strategy, where I've got 3 years of cash. And this is important to think about this. You've got to position yourself for this before you get to retirement, right? What if you were planning on retiring in early 2022 and the bear market hit and you hadn't built up your cash yet, right? So that's why thinking about it 2 years before retirement is important, because you need to have time to, Karsten's point about tax location. You've got to make sure you've got taxable liquid assets that you can fund those first couple of years of retirement with. So I took the last 2 years of work. I wrote a post called the Retirement Drawdown Strategy. I sent it out to everybody. Karsten actually participated. We actually built a blog chain, and I think there are 22 bloggers that posted similar posts about what's my retirement drawdown strategy. And every one of those is linked down. So we can send you that link. You can put it in the show notes. But it's 22 different bloggers and how they were thinking about setting up the retirement drawdown strategy. So that's a broader overarching strategy. And then this bucket strategy that I'm talking about is an element within that. And that's really how do I feed that monthly paycheck? So that's number one. So let me touch quickly on the bucket strategy. And I think the tax location is interesting too, because mine's quite a bit different than Karsten's. I've got a lot of before tax IRA money, 401k money that I'm doing Roth conversions quite aggressively on. So there's a difference there. But first, let's touch base on the bucket strategy. I built up 3 years of cash by the day I retired. I didn't want to retire until I had 3 years of cash in my account ready to go. Then I've got bucket two, which is, and let's say you've got a 30-year savings and your withdrawal rate's going to be 3.5%. If you've got 30 years of savings and you've got 3 years of cash, by definition, 10% of your asset allocation is cash. Okay. So then I built about 6 years in bucket two of bonds. 6 years out of 30, that says a 20% allocation. So roughly 10% cash, 20% bonds. The rest is in primarily stocks, although I do have some alternatives, mainly REITs, but I've got some commodities. I've got some other stuff. I also do option trading, although not as aggressively as Karsten. So that's all kind of bucket three. And the intention of the strategy is to avoid having to sell your equities after a downturn, because you've built these buffers ahead of it that will allow you to go through 3 years of cash, potentially 5 or 6 more years of bonds, allowing your equities to recover in the bear market. That's the overarching philosophy behind it. And that's where Karsten and I have some very good debates. It's not a cheap gimmick, Karsten. Come on. By the way, Karsten and I are going to Ecuador together for a Chautauqua. So anybody who wants to come down and watch us box, you got to come down. But so that's the master framework. And then within that, you've got to think about how are you going to get access? And this is the broader retirement drawdown strategy that I mentioned. How are you going to get that before tax 401k or IRA money? If you wait until the RMDs, that money cannot be converted into a Roth because the RMD has to come into taxable. So if you want to build your Roth, which is great for passing to the next generation, to your wife, whatever, because it's tax-free, you've got to do some of that before the RMD kicks in. And that really comes into what you're spending going to be in retirement. So I made the conscious decision with the 2018 tax law. They made a very favorable move for married filed jointly, where the tax rate is well into the $300,000 range at 24% marginal. So we've been doing literally six-figure Roth conversions because I've only got a certain amount in taxable. The majority of my money was in my 401k, which is IRA and Roth. So a big part of my strategy is making sure I've got enough money accessible without having to get penalized by inadvertently getting bumped into a higher tax bracket. So I'm managing the conversions up to the marginal tax bracket that I'm in, and then I've got that money available at any time tax-free. So that's an element that's behind it, but it's really important to think about when you're thinking about how do you want to set up your withdrawal strategy. You've got to look at this tax location issue because it's big.
Okay, so Fritz, I just want to make sure I understand, and especially for people who aren't entirely clear with what a Roth conversion is. So basically, you have dollars saved in pre-tax retirement vehicles, like a 401k or an IRA. And ultimately, you're trying to get those dollars out of there into a Roth IRA. So when you withdraw, that is actually a taxable event, right, for the full amount that you've pulled out of that pre-tax amount. Now that goes on your tax return, but you're saying because you have some certainty in terms of that marginal bracket, which has now been expanded, that you and your wife have judged, okay, we're comfortable paying, I think you said 24% federal. And then is there a state tax component as well where in the state you live?
Yeah, there is.
Okay.
Yeah, and really it comes down to, that's probably a little bit off topic for the real focus of kind of funding the short term, but it's important to keep it in mind as part of your spending strategy. We are intentionally incurring income tax hits now because once Social Security starts, obviously, that would be incremental income. And we're taking a little bit of a view on future tax rates, which in my opinion are probably more likely to go up than down. So we're saying for both of those reasons, let's go ahead and take some tax hit now. A big factor is if you're getting the ACA subsidy on healthcare, you probably don't want to do it because it'll blow up your subsidies. We're not eligible for the subsidies already because of my pension and, I've got a little bit of income stuff going on. So, but that's your first consideration is what's your subsidy look like if you're getting it? Don't blow that up. So it's a fairly complex subject that needs to be factored in because ultimately you need to get your money out. If it's all in before tax and you're planning on just spending that, recognize you're not going to be able to spend that without losing X percent of it to taxes whenever you tap into those funds to fund your retirement. You're not going to get it all, right? So it's got to be done in conjunction with your retirement drawdown strategy.
And you said before, quote, staying within my safe withdrawal rate. And I'm curious, how do you think about like what your safe withdrawal rate is? Is it a fixed number that was set in stone in June of 2018? Is it constantly moving?
Yeah, and we can talk. Obviously, Karsten's the expert on this. And coincidentally, his conclusion when he was doing a lot of these series probably changed now with the bear market. But at the time, it was 3.3%. Correct me if I'm wrong, Karsten, but 3 to 3.3% was always kind of the safe range. So within that, if you can get a dynamic spending scenario where you're willing to move your spending up and down a little bit, you increase the probability of that tremendously. So what we do is every year we update our net worth, and then I pull out our non-spendable assets like our house, like our cars. So we just have our retirement liquid assets. And I multiply that times 3%, 3.5%, well, 3.25%, 3.5%, 3.75%, and 4%. And I get a range of what my spending can be. So if the markets come down, but we don't necessarily want to reduce our spending, I may decide, you know what, we'll go to 4% for the next year, and we only have to knock off a couple percent of our spending level. Or, maybe we have something we know we want to do. We want to go on a big vacation. Fine, I'm still under 3.75. I'm okay with that. But I multiply it every year by my updated net worth to make sure I kind of have guardrails around my spending adjustments. I think Karsten takes a little bit different approach, but that's how I do it.
Right. So again, there isn't one single fixed safe withdrawal, right? It should be personalized in the sense that, well, people retire at different ages. They retire with different pensions and social security benefits that they expect. So my approach was that I did a very bare bones safe withdrawal study, right? Imagine I never make a single dollar again in my life, neither social security nor pension or anything like that. So that's roughly that 3.3 or anywhere between 3.25 and 3.5% safe withdrawal rate should survive a 60-year retirement, 50 to 60-year retirement. But you should also take into account that potentially later in life, you might have some additional health expenditures. You might have to account for nursing homes. Maybe that will eat up all of that social security benefits that comes in as extra later in retirement. So I said, well, maybe that's a wash for me. So that's how I ended up with that 3.25 to 3.5% withdrawal rate. So I applied that to my portfolio at that time, and that was our budget. Now, luckily, after retiring in 2018, our portfolio is actually up, despite two bear markets in between, for sure, one recession, obviously, in 2020. People are now thinking about, could this be a recession now in 2023 with the Fed raising rates? So even with quite a bit of market volatility, my net worth is actually up. So my effective withdrawal rate, because our budget hasn't really changed much, is actually now probably below 3%. And it's not like we're going to go out and spend the extra. We're still going to keep that retirement budget roughly the same. But that's how I set up at least my initial safe withdrawal rate, just to get a rough idea how much we can spend in retirement.
Let me make one comment on this, because Karsten, when you said, obviously, we're not going to increase our retirement spending, I would encourage people to think about that. Most people that listen to the show, myself included, Karsten, you included, we've been lifelong savers, right? We watch every dime. We're so frugal because we want to get to early retirement. We want to reach FI, right? Well, we've achieved FI. And you've got to change that mentality to where, how can I get myself to where I'm more comfortable spending in retirement, knowing I can spend up to 3.5%? Okay, be conservative, 3.25%. Well, dang, we should at least spend 3.25%. We've all proven it's safe, right? So one of the things with the way I've structured the paycheck with the bucket strategy is that money flows in every month based on that safe withdrawal rate that I know I can spend. And if I don't spend it, my checking account starts going up month after month after month because I'm not spending what I'm allowed to spend. And it's a really different mentality. But as we saw our checking account growing, my wife and I talked about it and said, hey, we're not spending all the money we can spend. So I built a workshop, and I've got a writing studio now. And, we're intentionally spending. We're giving more to charity. We're supporting some causes are near and dear to us. I would encourage people to think about changing your spending mentality from being a lifelong saver to try to stretch yourself to spend what you can safely spend. That's why I wanted to jump in there, Brett. Sorry, it's a passion of mine. It's hard to change those habits.
No, that's a great challenge. And it is very hard to change those habits. I know I've mentioned this a couple times on the podcast recently, but the book Die with Zero by Bill Perkins is something I've read over the last year. And I've heard him on a couple podcasts recently. And it has helped change my thinking fairly dramatically, especially where I am. We're all in obviously different stages of life, but where I am in life with my girls, and they're growing up fast. And then you think about an article like The Tail End on Wait But Why, and you realize that literally from 0 to 18, essentially every single year you spend with your child is 5% of the time you will ever spend with them. So you're at 90+% by the time they leave for college, which, we can argue over whether the precise accuracy of that, but it's pretty darn directionally accurate. And it's frightening when you think about that. So, okay, if you're going to hoard this money and you're going to be a decamillionaire when you're 90, would you rather have spent some of the money? So it is a great challenge, Fritz. And Karsten, I'm curious, has that crossed your mind at all?
Yes. Obviously, you want to give your money. I don't want to completely cut out our daughter. So we have one daughter. And so what I like about the idea in the Die with Zero, right? You don't want to wait until you die to give a huge inheritance to your kid, who might at that time already be in her 30s, 40s, 50s, or 60s. So you want to give money over time and impact your child's life. And so, absolutely. This is exactly what we're planning to do. And it goes exactly into this philosophy. So for example, I got pretty lucky, right? I didn't get much support from my parents, but I actually was able to save for a down payment, right? I had a modest house when I lived in Atlanta, and then that grew as enough equity. And then I had enough down payment to buy a condo in San Francisco, right? Outrageously expensive city at that time. So I sometimes wonder, young people today, do they have that same opportunity still, right? I mean, you in a lot of places, you need a six-figure sum to just show up with a down payment. And if you don't get some help from your parents, it's going to be much harder than potentially the life I had. Now, every generation always comes up with this theory, oh, we're the last generation that had it good and everybody else is just going to totally suffer in the future. And then, of course, you see GDP growth and technology growth and productivity growth comes in, and then it's always wrong. But I mean, heed my words. Maybe I might be right this time, and that maybe our next generation will have it harder. So the whole gig economy, younger people will have it harder finding these nice, cushy corporate jobs. They will have it harder time coming up with the down payment. They will have a harder time paying down their student loans. So yes, absolutely. I mean, we are totally planning to not give our daughter some kind of a trust fund baby experience, but I mean, help enough that it's impactful, but not so much that she forgets what this is all about, what life is all about. Yes, absolutely.
I think one other thing, Brad, you mentioned your kids and how quickly they go. Well, don't be surprised when you get into retirement, grandkids come up pretty quick too, right? So you're kind of going through it all over again with the grandkids. And that's where we're at now. We have a 4-year-old granddaughter. And as I talk about this spending mentality, one of the things we're saying is, look, let's invest in experiences for our granddaughter that our daughter maybe can't afford, to Karsten's point, right? Kids do have it tough these days. She's in her late 20s. So, I don't particularly care for Disney World, and I just shudder at the costs. What the heck? We're taking her to Disney World, right? We can afford that. So we're going to go to Disney World in April. We're going to make a big thing out of it. We're going to rent a condo with a pool, So finding a way to do experiences rather than material things. And I think Karsten's right, helping them with a down payment, doing things to help them get established that isn't necessarily money they can just burn through and waste, but maybe you're building equity in their house. They can't tap it, but it's going to generate wealth. Those types of areas to give and support your family, I think, are things to think about if you're finding yourself, which nobody believes it'll happen, but it happens to most people. You underspending in retirement is a real issue. It's common. Now, not among everybody. Some people obviously are very much struggling, but I would bet the majority of people on your show that listen to your show are probably going to be in a space where they're going to be underspending in retirement. It's very common for people that have been diligent about saving. So just a point, I think it's worth pondering.
Yeah. I mean, for example, there's this sentiment, well, what if I spent only the dividend yield of my stock portfolio, right? I mean, if you did that and you look at how a stock portfolio without the dividends, how that would have performed, it would have grown astronomically, right? You apply that to a retirement of 40 years or so. So you will vastly overaccumulate if you only spend the dividend yield of a portfolio. So yes, I mean, absolutely. And I try to bring this back to this bucket strategy discussion in the end, obviously. So I think if a bucket strategy approach helps people to spend more comfortably and confidently in retirement, I'm totally up for it. And again, I didn't want to sound too much like a miser or anything like that. We probably spend more now, especially with inflation up a little bit. So, for example, we have 3 cruises planned for this year, right? We do a cruise during spring break to Mexico. We do a Baltic cruise in the summer, and then we do a very exotic cruise. We do a cruise from Istanbul to Dubai through the Suez Canal, visit the Holy Land, visit Egypt, Jordan, Saudi Arabia, Oman, and Emirates. So that's later in November this year. And it's actually our daughter likes cruising, so she has already developed a little bit of an expensive taste in terms of her vacations and restaurant preferences. She likes sushi. I mean, but I don't think we are spoiling her. But yes, I mean, we definitely spend, and we spend confidently. And then again, I don't want to put this too much into the tax discussion, right? I mean, you can spend $100,000+ as a married couple, and you still stay within these really advantageous tax brackets, right? So you get your standard deduction. Then there's a little bit, as once you receive Social Security, not all of Social Security is taxed, obviously, right? Only maximum of 85%. And then the next 2 tax brackets are at 10 and 12%. And a lot of, in fact, all of your capital gains, long-term capital gains are taxed at 0 in those first 2 tax brackets. So you can run your withdrawal strategy actually very tax efficiently. But yes, so again, let's bring this back to the bucket strategy, which in fact on Fritz's blog and in the blog post there we published then on my blog, people were surprised how how much we were on the same page, actually. So I actually agree that with the general idea of having something like maybe 70% equities, 20% bonds, 10% cash, that's not a bad allocation. And so, for example, if you plug this into my safe withdrawal rate simulation tool, that gives you relatively robust results. Is no matter what the market throws at you, whether that's another Great Depression or whether that's another dot-com crash or whether it's another 1970s style inflationary recession, where both stocks and bonds go through a little bit of pain. So no matter what the economy and the stock market throws at you, it's going to be relatively robust if you stick to this 70-20-10 asset allocation.
Karsten, we're making a really good point here. The differences that Karsten and I have are more in the minutia of the implications of this. So I think the takeaway I would have for somebody is number one, you've got to have a plan before you retire. And you've got to think about how are you going to transition from a life of accumulation to position yourself for this 40 years of withdrawal. That's number one. Number two, you've got to think about what are your goals for the strategy that you put in. My goals are probably a little bit different than Karsten's, which is why I think we disagree a little bit on whether the bucket strategy is optimal or not. He would argue that I'm potentially not optimizing my returns. But when I look at what is my purpose of the bucket strategy, generating alpha or excess returns is not my goal. My goal is to have a comfortable replacement to my paycheck that I know I can spend, where I have some comfort that I've got a cash buffer. So if we get into a downturn, I can mitigate the sequence of return risk, right, which is a bear market early in retirement. And it's to have a structure that's easy to explain to my wife, to my readers. It's easy to implement for me. And it just gives me peace of mind. I don't worry. The 2022 downturn, I didn't lose a single night's sleep because I know I've got 3 years of cash. And this is where Karsten and I will get into some debates, and maybe we can move to that next. But for the purposes of what I was trying to create, it fits those criteria very well for me. So I think get a plan, most importantly, and figure out what it is that you want that plan to achieve. Those are the biggest takeaways as you're thinking about a drawdown strategy.
So here's another disagreement I have with Fritz. I'm not even saying that a bucket strategy is not optimized, that it would do worse than just keeping that 70-20-10. Sometimes people fall into this, it's called the false dichotomy fallacy, right? They say there's only two options, and well, it can't be this option, so it must be that option. There's actually the third option, right? So the bucket strategy, it's between being always better and always worse. There could also be this in between where, it's on average, it's probably exactly the same as just a static 70-20-10. And then sometimes it does better, sometimes it does worse. I can't tell you when it does better. I can't tell you when it does worse. I mean, after the fact, I can point out when it did better and when it did worse. And I can tell you why it did better and why it did worse. But so we are actually more aligned even than that. So I think that on average, Fritz's approach will give you the same results as my approach, as just plugging in some numbers and a fixed asset allocation into a retirement simulation tool. So what I always want to stress is that so people fall for this fallacy, I think, that if you have enough cash to make it through a bear market, you don't have to worry about anything. Because you think you solve one problem, but you actually create more problems down the road and more headaches and more, actually also pitfalls. Because once you deplete a certain bucket, right, you have to decide when do you refill it. Do you keep it depleted until the market is completely recovered, which could sometimes take 5 years, 10 years, more than 10 years, in fact. For example, if you look at stock market returns from 2001 until 2013, the stock market was flat between 2001 and 2013. So this is with dividends reinvested, but also inflation adjusted. And the S&P 500 did not recover, not even in 2007, when we had another all-time high just in the index, but that's the nominal index. So inflation adjusted, the S&P 500 was down for 12 and a half years or something like that. So if somebody says, well, all I need is a cash bucket of 3 years, because 3 years was the length of the worst bear market. Well, the length of the worst bear market, say the Great Depression, 1929 to 1932, it's not enough to have cash to only make it on the way down, right? You also need it on the way up. This is the entire idea of sequence of return risk. You are depleting assets at depreciated prices. It's not enough to hedge only the way down. You have to hedge the way up as well until you reach the new all-time high. And then the new all-time high can't just be the nominal value of the all-time high. It has to be the real inflation-adjusted value of the stock market. So sometimes that's very quick, like 2020. It took only a few months for the market to recover again completely. Right now, with inflation, we're still down by probably more than 20%. Looking here in early 2023, so the 2001 market peak, that took until, I think, early 2013 to recover again. So it's a little bit of, again, if it helps people psychologically to get over the hump to consume, that's all fine. But I mean, I'm too much of a scientist and too much of a numbers geek to believe that you can completely hedge against every possible thing that the market throws at you. So that's really the only disagreement we have.
Yeah, that's very helpful. And Fritz, obviously, I want to get you in on here, but just for some clarification, Fritz, because if I'm in the audience or if I'm frankly in my own head right now and I'm curious of like, okay, why are you doing this? Because as Karsten was saying, and I do like your method, so it's not a critique of it, it's just a curiosity factor of if I could put words in Karsten's mouth, he's saying, okay, 70, 20, 10, perfectly logical. But maybe for the reasons that it's being done of, okay, I've got these 3 years of cash and that's going to tide me over no matter what, that might be not the greatest argument. And I guess to clarify that, I am curious, and I think this will help, is in normal times. So let's say there's no major stock market drop. You've got your 3 years of cash and presumably you're drawing down on some of that, though that might be an erroneous assumption. So that's my first question is the 3 years of cash, is one of those years essentially depleted for that year's spending? So that's question one. And then right on top of it, and I hate to ask two questions at once, but in a normal time where assets are not depressed in value, are you selling enough so that at the end of that year, you have another 3 years, if you will? So in essence, you're just emptying the prior and then filling up.
So we're getting into the mechanics of how does this work and what do you do in an up market? What do you do in a down market, which is a great place to go. So let me touch an up market first. When I first set it up, I figured, okay, at the end of the year, when I do my annual financial review, it's the only time of the year I look at my net worth, by the way, is December 31st. I look at it once a year and I don't worry about it. You don't need to look at it more than that. So my initial thought was when I do my net worth update at the end of the year, I'll refill bucket one. So it'll go from 3 years down to 2 years and then I'll refill it back up. What I found, remember, Karsten and I retired in 18, 19, okay, 20 had a little bump, but it came right back. 21, they were all bull markets. So as I started thinking about it, I said, there's no reason I can't do this more frequently than end of the year. Because what if I waited until January to do my refill, but we had a bear market in December? I just lost a year of my protection, right? Because I waited. So I started doing quarterly refills. And all I would do is I would look at this Capital One account, which was a standalone account. I didn't even have to track my spending because all I had to do was look at my January 1st balance, look at my March 31st balance in my Capital One, which funded all of my spending, subtract the two, and I'd know how much I spent, right? It's easy. So now I know how much I need to refill. I'd look at the market. I'd look at my asset allocation. Stocks were on a tear. So my stock allocation was always up. Not a lot. You're talking 3 months, but it might be up 0.5%, 1%, depends on what the market was doing. So for the first couple of years, every quarter I was selling stocks and moving them to cash. So I would always have at a minimum 2 years and 9 months of protection. And then at a maximum 3 years. And I actually had a little bit more than 3 years. A lot of people end up with too much cash. They're nervous. When do you get back in the market? Right? That happens. So I took advantage of the 2020 downturn and I actually reinvested the excess because that's the other thing the bucket strategy does. It puts a cap on how much cash. You can say, I want 5 years of cash. You can design it any way you want. But once you design your risk profile and the structure that accommodates it, if you have more cash than that, that's your incentive to make sure you're investing that cash and putting it to work. So that's number one. That's how I manage it short term. To Karsten's point about the 3 years down or, maybe 10 years down, I would argue that his methodologies, I don't know if we really got into that. Hey, you just rebalance every quarter, 70, 20, 10, 70, 20, 10, 70, 20, 10, 70, 20, 10. Well, to me, let's say the market's down 20% and cash and bonds are great. Your asset allocation just went down. Okay, fine. You're going to use your cash and you're going to buy stocks, right? In a down market to rebalance to 70, 20, 10. So that wouldn't protect that cash buffer at 3 years. You're actually intentionally drawing it down because your overall portfolio has come down. So It's really a question of, do you prioritize cash or do you prioritize asset allocation? And if by prioritizing cash, does it potentially come across as you're kind of trying to market time? Okay, that's a debate we can have, because it does take it away from a strict mathematical formula. And there is a bit of a subjective call as to when you start drawing down bucket one. So bull market, we refill quarterly, everything's fine. What happens when the bear market is in 2022? Well, unfortunately, my father passed away. So there was some life insurance I got. So that refilled bucket one early in the year. April, May, I think that settled. And then, and this, I guess, is where I would argue against Karsten's argument that you could be down for 15 years. If you've got a diversified portfolio, even in a down market, you're probably going to be able to find something that's somewhat countercyclical. And again, from my dad, I inherited it was a defense stock that was actually at all-time highs in like October. So I sold a particular stock in October and refilled bucket one. So even in a bear market, by selectively looking at what had done well in my portfolio, I was able to selectively sell something and keep bucket one full. So I don't think you'd be in a situation where you would go 10 years and not have an opportunity to sell something, right? As I mentioned, I have this alternatives bucket where I do, the option trading. I've got some commodity stuff. There's typically something available that you can sell if you get into a pinch. Combine that with this dynamic spending. If your net worth is going down year on year on year because of an extended bear market, you're going to be pressured to reduce your spending as well, which is a natural human reaction. So I feel like those things combined with bucket two, which we haven't even talked on, rather than just buy mutual fund bonds, which you might have to sell in a downturn because the interest rates are going up, I'm actually structuring bond ladders in bucket two. So I know I've got cash maturing in December of 24 that's going to yield 4.5% between now and then. And I'm going to get half of my year's spending that matures in December of 24, regardless of what the market does, that I can use to refill the bucket. So there's ways you can build some defenses. So I guess that's how I'd respond to Karsten. Hopefully people follow all that. Did that get inside your head?
So my response is, obviously you can't really assume that you will get, say, an inheritance or a life insurance payout at the opportune time in a recession. And then, obviously, is a good point, right? Because when you inherit assets, you get the step-up basis, right? So you have this hugely appreciated stock, right? Sell that and invested in something else. It didn't really do anything to your allocation, right? Because you sold one stock and you bought potentially then an index fund. But the one point I wanted to make is that the question is, does this all make any difference? So for example, what I assume in my simulation tool is that you actually rebalance every month, right? And it's not because this is such a great assumption for the average retiree, but it makes the simulations really simple, right? Because you can calculate your portfolio returns very easily, right? You have your stock return, your bond return, your cash return, and then all of the other returns. I think I have gold in there. I have some pharma French factors in there, international stocks. For the total finance geeks, if you want to totally geek out on safe withdrawal simulations. And it's actually easier to assume that you do the monthly rebalances, because then the returns, they just fall out. It's just a weighted sum of your individual returns. Doesn't mean that the average retiree actually rebalances every month. I'm not rebalancing every month, right? I'm probably not even rebalancing every quarter or year. I withdraw money, and as long as I'm within a few percentage points of, say, that magical 70-30, 70% risky assets, 30% safe assets, let's put it this way. If you're anywhere between, say, 60 and 80%, you're golden. So I'm not saying that everybody should do this monthly rebalancing or quarterly rebalancing. What I say really is that if you do anything different from that monthly rebalancing, you don't really have consistently and reliably different results, right? It could sometimes help you by a few percentage points over a long time. Sometimes it hurts you. Really, the only thing that I've noticed in my research is that, say, a reverse glide path, where you start relatively cautiously and then you shift back into riskier assets, that will help you at least during the worst case scenarios, pretty consistently helps you during the worst case scenarios. It's going to hurt you if you're not in the worst case scenario, right? Because it's almost like you buying insurance. if your house doesn't burn down, then that insurance premium was a kind of a waste. But you want something that only pays off if your house actually burns down. And then if nothing bad happens, then you actually have a small loss, but you're still happy because you had that insurance coverage. So it's a little bit like that with this reverse glide path. But everything else in any either systematic or completely discretionary method, you are deviating from that 70-20-10 over time. And these deviations are very high frequency, right? They change maybe only every month a little bit, but over the very long term, you'll always be back at the 70-20-10. None of that is really adding much to your portfolio because we are not very good market timers, right? Because if you want to time the market, you want to time when are equities doing better than bonds versus cash, there are lots of people that are trying to do the same thing. You can try it, but the best you can hope for is that on average, you're about the same as the average.
So, Karsten, I want to kind of cut to the essence here of the cheap gimmick. So let's go to that, because I think what I'm hearing, and obviously there could be some nuance that I'm missing, but what I'm hearing is that it doesn't sound like you disagree with Fritz's overall asset allocation.
Right.
It almost sounds like a semantic thing, which might be where this cheap gimmick is coming in, is like, okay, I have these 3 years of cash, which is funding my next 3 years. But yet, as Fritz just said, but I'm actually selling assets, and you could make the argument you're just living off that, right? So like, is it a semantic issue?
Yes.
Or is it that discretionary aspect that you just mentioned? Like, that's how I'm seeing the essence of the disagreement, but I'd love for you to really dive into that.
Right. So again, I mean, lesson number one in blogging, right? You have to come up with catchy titles and catchy blog titles. I think one of my most popular blog posts is how to lie with personal finance, right? And of course, it's not how to lie, it's how to spot other people's lies. Yeah, so the cheap gimmick, again, we have to make sure that I'm not saying that it is worse than what I'm proposing. I don't think Fritz is saying that it is in any way superior from an asset allocation and tactical, especially tactical asset allocation point of view. So I just say that it's not consistently better. And if it helps you over this bump to consume and withdraw money confidently and comfortably, I'm all for it. So the gimmicky part is that some people might misunderstand it and think that they are doing something that they are not, right? That they are tactically timing themselves through a bear market, which is extremely difficult because you can always pinpoint it after the fact what would have been the right way to do it. But in real time, it's very hard to do that. And by the way, I want to make sure that even though in my simulation tool, I assume a very regular rebalancing, if you don't do the rebalancing very regularly, and I did simulations on that, right? What if you rebalance only every 2 months, every 3 months, every 6 months, 12 months? Results are not really that different, right? So it's not like you can suddenly go from a 3.5% withdrawal rate to a 4% withdrawal rate because you're such a good market timer. And I'm not saying that this is so bad that suddenly is going to totally blow up your retirement. So, and I think we both had a very good final comments on Fritz's blog post. And I said that, look, we've obviously had a very nice and comfortable retirement. And I said it's not because Fritz had the bucket strategy or I didn't use the bucket strategy. I think we had relatively good returns. And again, maybe from a purely psychological point of view, if Fritz slept better through the downturns, that's good. So then the bucket strategy helped him. But for example, what helped me was that, look, I mean, I did my simulations. I knew that my strategy was robust and would have survived the Great Depression and the 1970s inflation shock. Well, what do I have to worry about if we have this relatively mild inflation shock in 2022 is still not as bad as the 1970s. So I'm also safe. So that helps me. And different people use different, say, psychological crutches. And for me, it's actually more of the quantitative and the simulation tools that I'm using.
Yeah. And Karsten, what's so interesting about that is I think at its essence, each of you are using your own background and rationale for that kind of sleep well at night test. I'm going to read off something from Fritz's article. He said, however, with regard to my preference for the bucket strategy, it's driven by my belief that the typical reader, and I assume by extension him, is seeking a methodology for managing the withdrawal phase that is relatively easy to understand and implement while providing some level of protection against sequence of return risk. And Karsten, you just said, kind of, I'm reading between the lines, what helps me sleep at night is I've run this through the simulation and it passes the test of the, hey, this would have made it through these horrific events.
Right.
So therefore, I sleep well at night. So what's actually fascinating here is there's much more in common. And obviously, you guys know this, but there's much more in common here than separates you. And that's where the fun part of maybe the cheap gimmick comes into this. But we each have our own background psychologically, right?
Absolutely spot on. And something I think listening to Karsten speak, and we might not have reiterated this strongly enough, and I think we should. Kitsis has done some work on this. Regardless of what strategy you use, the importance of rebalancing is huge. Okay. So if you do it once a year, which is basically what I look at it every quarter when I'm doing my refill, I look at my asset allocation and I might use that as a decision making on, okay, stock allocation up. So I'll sell a little bit of that to refill bucket one. But a real formal rebalancing I do every year at the end of the year. And I look at my portfolio and basically what that forces you to do is sell the stuff that's winning and buy the stuff that's losing. And over time, that's a feature of any withdrawal strategy that significantly improves your odds of success. So don't overlook rebalancing. I would also say don't overlook dynamic spending, where you do some kind of a tracking of your net worth and you're making sure you're not just spending like everything's great when the world's falling apart, right? Have some discretionary spending built into your budget that you know you can sacrifice. And as long as you can make some comfortable adjustments downward in your spending, you're keeping track of it, and you've got a system that avoids you panicking when the market goes down and you sell all your stocks or something, crazy like that, either one of these is going to work, right? I think that is the point.
Yeah, so I mean, these rebalancing rules, I find this really fascinating, right? Because the rebalancing, it does things that, for example, a lot of us didn't face this problem so much during accumulation, right? Because a lot of people in the FI community, they are 100% equities on the way to retirement, or at least most of the time. Maybe until a few years before retirement, you didn't have to rebalance much. You just put everything in VTSAX or whatever your preferred fund provider is. But the rebalancing becomes more of an issue when you're retired, because the average person should not have 100% equities in retirement. So the amazing thing about this rebalancing is, right, what do you do if your weights deviate from your target, right? Do you let the profits run, right? Because sometimes momentum is a great thing. So imagine you've had stocks and bonds over the last 10 years, right? Actually both stocks and bonds did halfway well, but stocks did a lot better, right? Do you let the profits of the stock market run? And then you always chip away from your stock portfolio and put that into bonds, or should you just let the momentum run? The problem is if you let the momentum run and you let your stock percentage rise too high, then right at the turning point, that's when you get hit the worst, right? Because then you have the next bear market and you're at way more percent in the stock market. So there's this interplay between momentum and valuation, right? Valuation is exactly what Fritz described. By rebalancing, maybe not every month, but at least occasionally, you are selling the winners and you buy some of the losers. Well, the winners, they might have gotten a little bit too expensive for their own good, right? So it's actually good to sometimes take some of this risk off, right? So imagine all of these Bitcoin investors, right, that went all the way up to $65,000. If they had been smart, they would have taken some money out of Bitcoins and put it into some other assets. But then basically the bubble bursts and you lose it all again. So you want to do the same thing, obviously, with your retirement portfolio. You have some safe assets, some risky assets. Risky assets might get a little bit too expensive over time, so take a little bit off of that. And this is exactly this asset allocation, and especially this tactical asset allocation, why that's so difficult. When do you rely on momentum and when do you rely on valuation? Right? Do you let the profits run, or do you take the profits and move it back to the safe assets? And then the same thing on the way down, right? The stock market has already gone down. Should you catch that falling knife? Right? So that would be valuation. You now sell your bonds and reinvest into stocks. Or should you let it fall further. And I'm not going to touch equities for a while. So this is what makes this tactical asset allocation so difficult, especially for the average retail investor. So the best thing to do is to find a way to automate that, to take some of the emotions out. So Fritz would take his bucket strategy, and there is some methodology in that. I use my personal rebalancing. So whatever works for you. But again, don't try to time the market. Because, for example, you didn't use a bucket strategy on the way into the stock market either, right? I mean, you didn't say, or maybe some people do it, but I don't think it works very well for them, where they say, well, I first put my salary into my checking account, right? And then I let it sit there, and then I'm waiting for an opportune time to invest it in the stock market. No. So automate your investments. Don't try to time the market, because too often what happens is that people put the money in the checking account and then they miss the boat and they say, no, I can't invest in the stock market because it's up so high. I'm going to wait for it to drop again. And then they're going to sit there for 3, 5, 10 years and never invest that big cash bucket into the stock market. So I automated this part on the way into the stock market. It's also good to automate this on the way out and to take the emotions out.
Yeah, that's a brilliant point. I think that's something we've hit on so many times here at ChooseFI is our biggest opponent when it comes to investing is our own brain and our emotions. So yeah, if you can automate any aspect of your personal finances, the more that you can, the better, especially when you've set up, like you said, these rules. So I just kind of want to summarize just a couple of very important takeaways that I've gleaned. And I'd love for you guys to corroborate or add on. And then just wanted to touch on one extra thing, because it really does seem like you guys are very, very close here. And of course, you're great friends. So the whole cheap gimmick thing was kind of farcical as it was, but
poking the bear.
Yeah, exactly. Poking the bear. Beautiful. So clearly we've hit on asset allocation is very important. Rebalancing is essential. And we're saying for both of those, they're really in tandem. If we can automate this, all the better, because frankly, we're going to try to time the market. We might not do it sometimes. We're going to be ruled by emotion. So can you automate that? Wonderful. What I heard was safe withdrawal rates. Everybody's always looking for what's that number, right? So we have this very loose rule of thumb of the 4% rule, which of course we know is nothing but a back of the envelope. But Karsten, through your simulation, I think we talked about 3.3%. I think at one point you said 3.25%. And you said today that will get you through roughly 50 to 60 years, which should cover for essentially all of us, should cover a retirement or early retirement, whatever we want to look at it. So while by no means are any of the three of us saying that is a metaphysical guarantee that 3.3% is going to get you through everything, including the zombie apocalypse, right? Like, it's as close as we can get based on simulation. So I think there's some nice level of certainty in looking, even if it's slightly uncertain, in at least having that as a background number. The safe withdrawal of about 3.3%. So those are kind of like the main takeaways that I've gleaned. And then, of course, you guys are all of us are going to be in different situations when it comes time to actually pull that trigger on early retirement. Fritz, you're saying you had a pension. Right? I mean, that puts you in a different category than many people. And obviously, your strategy is adjusted because of that, clearly. So I'm curious if we could just kind of land this plane with if there is a such thing as a normal withdrawal strategy, because this goes back to how I led off the episode, which was you've asked, we've answered, right? A lot of people are looking for, hey guys, I've saved diligently for the last 20, 25 years. I have a significant amount of assets. They just literally want to know, like, how do I sell these things? And I'm not looking for mechanically, but like, how do you think through like hey, I don't have a pension. I don't have any kind of like blog income or anything like that. Like, could you give each of you just a couple minutes of thoughts on what you would tell that person? Because almost invariably, that person has reached out to each of you on your blogs.
Yeah, let me jump on it first, I guess, Brad. I guess the only other thing I would add to your excellent summary is also focus on the tax brackets. How much do you have in your taxable accounts, especially if you're retiring early and you've got stuff that you can't access until age 59 and a half. You can do the rule of 55. Let's not complicate the matters, right? You've got to have enough after-tax liquidity to bridge yourself to when you can access your retirement funds. Make sure you factor that in to the point where If you're going to retire at 50 and you're 48 and you start doing the math and you say, geez, I don't have enough in taxable accounts, maybe you stop investing in your 401k and you start injecting it all into after-tax accounts. It's that drastic to make sure you've built enough in the after-tax as part of your strategy so that you have liquid funds that you can access. That's number one. The second thing, to your point about the emotions of this, and they definitely are a huge factor, right? I love the whole behavioral psychology of personal finance. If you think you get anxious in the bear market while you're still working, try it once you're retired, right? Once you go fine and you give up the paycheck and you say, I can do this, and then the market goes down 20%, you're going to have a whole new level of anxiety. So make sure as you're building your drawdown strategy, you've done something to address that. Either you can run a bunch of simulations like Karsten says, I know I can get through anything, I'm fine. Or you can do my thing where I say, look, I'm going to keep a little extra cash because that gives me comfort. But address that anxiety because it's going to get worse. So those are the two big factors. Summarized, easy, how do I do this? Set up a system where you're generating something automatically coming into your checking account. What I do, I've got all my Vanguard stuff. I've got the standalone Capital One 360. I've got that as kind of a holding tank so I can make moves in my portfolio and move the cash over there. And that just becomes an automatic funnel into my checking account every month. I don't have to worry about it. I can spend it. I can look at the balance. Okay, I got another 12 months of cash sitting in there before I have to really freak out about anything. And as you're going through it, just review your portfolio every quarter at a minimum every year. Look at the rebalancing. Look at what's done well. Look at your cash position and figure out what should I sell to refill the cash to the level that I'm comfortable with, and what mechanism do I want to hold that cash to give me the freedom to spend up to my safe withdrawal rate. Those are the key metrics of how you need to do it.
Yeah, so I do some of the same things that Fritz does. So I have a monthly withdrawal from one of my taxable investment accounts, and it goes into my Fidelity accounts. I have a Fidelity account. They also pay pretty good money market interest rates. And then from the Fidelity, I can directly pay my credit card. I use pretty much only one credit card for most of my transactions. I can pay the credit card from there. I can also put money into my Wells Fargo checking account. And so I also have this automated system. Now, obviously, again, experience will differ for every individual, but I mean, the experience of selling assets, right? I mean, that is already this harrowing experience. And I mean, I would probably suggest something what Fritz has, and it could be a variant of Fritz. I wouldn't call it a bucket strategy, right? I mean, you look at your asset allocation. If some asset is above its target weight, right? If equities are at 71% and you need to fund your expenses, well, sell some of the equities. Then this very easily devolves into tax planning, and I'm not the expert in that, but I think there are a few rules of thumbs, right? So I would probably start with the higher cost tax lots to lower your taxable gains. Again, if you have some estate planning, right, you want to give the tax lots that are the cheapest tax lots that have the most capital gains built in. This is what you want to give to your kids because they get the step-up basis. So when you liquidate your returns, your long-term capital gains, look for the ones that have the least amount of capital gains tax. And then eventually, obviously, you will get into this issue with liquidating not just the different asset classes, but also the different accounts. I mean, don't wait until you're 75 to tap your 401ks and regular IRAs. You do some already distributions before that. Basically, you want to smooth out your taxable income. You don't want to have zero taxable income now, and then you get hit with the highest tax bracket when you're later in retirement. Smooth that out. But so probably similar to what Fritz would do, right? If my equities are above the target weight, I would liquidate equities. If they are below, I would first liquidate some of the safe assets. And then the question is, if even after liquidating only from the safe assets, is my equity weight still below the target weight? Then you get into this whole issue. Do you rebalance, right? And then do you want to become a market timer or not? So that's really up to you. How much confidence do you have in that? I feel this anxiety that people might have if they start liquidating their actual assets. But you have to. You can't just live purely off your dividends and your money market interest income.
Gentlemen, this has been fantastic. Certainly, we started with a lot of theory, but I think we really got into the nuts and bolts of the tactics. And I think that's going to really help a lot of people. I know for me, I did not fully appreciate the asset allocation And I think that's been extraordinarily helpful. And how you guys are both talking about there is this intersection between the tax implications in a lot of ways. And you both look at it, I think, slightly differently, which is very interesting, plus this asset allocation. So I think there's a lot here. I really, really genuinely appreciate you both coming on. This has been a lot of fun. So let's start. I know I mentioned your websites, but we'll start with you, Karsten. Best place for people to get in touch with you?
Yeah, earlyretirementnow.com is my website, and I'm on Twitter, so I usually respond to DMs there. And
Nice. Sounds good. And Fritz, you?
Yep, the Retirement Manifesto, and it's got the THE in there. Don't ask me why I put that in there, people. But search me, Fritz Gilbert, Retirement Manifesto, the Retirement Manifesto. You can find me. I'm all over. I'm on Twitter, Facebook, Instagram. I'm out there. Easy to find.
Nice. And this whole little battle royale started on Twitter. So yeah, You guys are both quite active there. I'm getting a lot more active on Twitter. I'm trying to be at least.
We've noticed
I'm at
that.
Brad ChooseFI. Yeah, I figured I've been talked into it. Brian Feraldi, who's a great friend of ours, has been talking to me about Twitter for probably 5 years now. And he's nearly 500,000 followers. And I'm understanding the value of it. And it's just fun, frankly.
Yeah, it is.
So yeah, I will certainly see you guys there. And again, thank you for your time. This has been really helpful.
Thank you, Brad.
Thank you.